Hey guys, it's Max. How's everyone doing this morning? Welcome to Austin. Hey, I was on Facebook yesterday and I saw this posting from Mike Venuto, who's the boss over at Tidal Financial. You know, he works with Jay on all these Yield Max. He's a sponsor of Yield Max and all this stuff. And Tidal and F.I.R.E are the sponsors of the actual ETFs themselves. All right. Well, he posted this yesterday that they've come out with the first ETFs designed specifically for the F.I.R.E community. F.I.R.E, of course, means financial independence, retire early community. I know a lot of you guys are really interested in that. Now, does Max F.I.R.E? Well, F.I.R.E wasn't around when I was younger. I had never heard of this. I'd always modeled my family's retirement plan, and that is to die with enough money left over for the next generation, ideally, if you can. All right, so I come from a long line of strong planners. So F.I.R.E prioritizes being able to quit early in life and enjoy life. So the maximum model, not so much worried about quitting work, it's worried about maximizing your life. I plan to work to the day I die, but I love what I do. It took me 40 years to find something I love what I do, but I love what I do. The ultimate flex to me is to be able not to work, but to still do it because you just love it so much. I'm working on a book right now. I'm passionate about teaching you all, and I plan to trade stock and options forever. I couldn't imagine not trading stock and options. All right, so my retirement model, the maximum retirement model, let's talk about that real quick because then we're going to get in the retirement simulator at the end, and we're going to look at how to achieve that. But we're also going to check out the prospectus of these. So it's of these two new ETFs. All right. So my idea is you have to maximize the savings opportunities, not so much to be able to quit, but to not have to quit because you hate your job, you hate your life, whatever. So this would include maxing out your plans that are available to you at work. You know, if you have any type of company match, any type of that, you know, get a good job, max all that stuff out. You have to do that. That's the first prerequisite. That's a prerequisite for F.I.R.E also. You know, make as much as you can, save as much as you can, live below your means. So I have a similar concept to F.I.R.E. I'm just prioritizing. I'm trying to prioritize the next generation and the generations after that's wealth and not mine so much. So the third element, and that's where the third element comes in. And this is a part of my plan, not part of F.I.R.E, the maximum plan. Build a portfolio and never run out of money. Build an endowment for your own family. An endowment is what a college does with money they have donated to them. They invest it where ideally it's self-sustaining, makes a self-sustaining fund of money that will never run out of money and pay the college and income and do all that kind of good stuff. Okay, that's what I'm interested in. Harvard's never going to run out of money, and neither's my family if I have anything to do with it, to the extent that I can plan for it not to happen. All right. So today we're talking about two new ETFs by a brand new company. Let's check out the prospectus, and then we're going to come back and we're going to get in the retirement simulator, and I'm going to show you how the maximum retirement model differs from the F.I.R.E retirement. Okay, so here is the prospectus. We'll start right here. You guys have already seen that. Okay, so here's the first page. It says the Security and Exchange Commission has not approved. This is dated November 8th. You know, so this is obviously preliminary. But the fact that Mike is putting it on Facebook and he's, you know, he owns Tidal Financial makes me think he thinks it has a good chance of, you know, this being pretty close to the final version. So he's putting the marketing out there, letting folks get comfortable with it. All right, so investment objective. The fund's primary investment objective is to seek long-term capital appreciation. Okay, well, I should say first, there's two funds. They have the wealth builder, and they have a wealth fund and an income fund. We're talking wealth right now. The wealth fund's primary objective is long-term capital appreciation. Okay, but these guys do it in a way that I haven't seen before, I don't think. This is really interesting. Management fee, 67 bips. Okay. Principal investment strategy. The fund is an actively managed exchange traded fund that seeks long-term capital appreciation as a fund of funds. It invests in assets in shares of other ETFs and to a limited extent other exchange-traded products, ETPs. The fund primarily invests in affiliated ETFs, meaning managed by Tidal Investment. So it could be Defiance, it could be Yield Max. Well, I guess actually not. No, probably not. It means they're first going to go with something managed by Tidal. They have their own funds. But it may also invest in unaffiliated ETFs and ETPs. So they could also invest in ProShares if they didn't have a product that met what they were looking for. And you guys will see what that means in a second. Okay, the F.I.R.E philosophy is the financial independence, retire early movement encourages individuals to achieve financial independence by aggressively saving and investing, often with the goal of retiring early. Participants typically aim to reduce expenses and accumulate substantial wealth through a combination of disciplined savings, investing in growth-oriented assets, and maximizing returns over time. The movement promotes a long-term approach to financial freedom, allowing individuals to retire or pursue other life goals at an earlier stage than a traditional retirement timeline, say like writing a book or something. So the F.I.R.E philosophy can definitely fit in with the maximum retirement. All right, strategy overview. I don't like prospectuses. I'm going to try to summarize this as much as possible. But the advisor allocates the fund's portfolio equally among 4 baskets of underlying ETFs designed to track the behavior of 4 distinct economic regimes. Each regime generally represents approximately 25% of the fund's portfolio. The 4 regimes are prosperity, which will generally be comprised of ETFs that are in equities. That's growth. We don't have to read it. It's growth. Okay, because that's prosperity. Recession, you can read it if you want, but recession, which will generally be comprised of underlying ETFs that are low volatility and aim to reduce risk and provide stable returns. So that would include long-short ETFs. I have a review on a long-short ETF coming out soon, but basically it's an ETF that's 50% long stocks and 50% short stocks. And they try to buy good stocks and short bad stocks, obviously. But what that does, that keeps them a market crash from hurting them. Because the market drops, their short stocks offset their long stocks. It makes them what's called market neutral. And it gives them a different, lower volatility return profile. But then this recession portfolio would also include alternative ETFs that focus on providing uncorrelated returns with the overall market. I'm thinking SFOL right there. I'm thinking some of these high yielders are somewhat less correlated, but I'm thinking of USOY and USOI, which are covered call funds on commodities. But in any event, in addition, this basket will invest in underlying ETFs that primarily hold cash equivalents. Okay. Then we're going to have the inflation bucket. So this one is generally comprised of underlying ETFs that primarily invest in commodities, so, physical goods, raw materials, that kind of stuff. Real estate, so that would be like REITs and stuff, real estate investment trust. And then other inflation beneficiaries, assets that tend to increase in value during inflationary periods. If I was them, I would look at RISR, R-I-S-R. I know this isn't a review about RISR, but it's my favorite. It's a badass fund. Go check it out and then tell me what you think about it. It's a badass fund. All right. So then it'll also have another bucket, which will be a deflation. So that'll generally be comprised of underlying ETFs that invest primarily in fixed income, securities, bonds. In addition, this basket will be comprised of underlying ETFs that are deflation beneficiaries, assets that tend to increase in value during deflationary periods. Okay, so they're going to have 25% in each. So, here's some examples of prosperity. I told you, I said, we don't even have to read it as growth. Well, look what they have in here. Vanguard Total U.S. Equity ETF. VU, VTI, SPY, Qs, whatever. That's prosperity. Okay. Recession would be like GLD. Inflation would be really short-term treasuries. Deflation would be longer-term bonds. Well, anyway, all right. Optimize. This was interesting to me. The advisor evaluates underlying ETFs based on price to earnings ratio. So they base it on valuation, not technicals. Technicals are like moving averages. But anyway, they base it on price to earnings ratio, sales figures, which is, revenue figures, return on equity, which is a measure of profitability, yield, which is a measure of income, and credit quality or credit worthiness. And they optimize the construction of each basket's portfolio. Okay. So they have 4 baskets: prosperity, recession, inflation, deflation. They're constantly optimizing, of course. So this tells you some other stuff. You guys can go get this. I don't want this to be too long, but the fund will generally hold between 10 and 25 ETFs. This is all pretty much basic stuff. Underlying ETF exposure, commodity ETFs, multi-asset ETFs, long short. We already talked about that. This is the principal and investment risk. There's so many different types of risk because they're doing all, these different buckets. So let me get through here. So anyway, but that's the growth one. You can see, that one should have something for every phase of the economy or of the economic cycle. Okay, so now I want to show you the one that's a little more interesting to me, and it's the one that's income focused. Okay, I already have a lot of good ideas for growth funds. I don't need another good idea for a growth fund, but that is a new one that I haven't seen. So I like that one, but as far as income, this is kind of a brand new frontier, and income funds have been popping up the past 2 years everywhere. So let's see what these guys are let's see what they're gonna add to the party. Let's see what he's gonna do. So this one's called the F.I.R.E Fund's Income Target ETF. Okay, so investment objective. The fund's primary investment objective is to seek current income. It says nothing about capital appreciation. So you have to buy the other fund for that. You would, in the F.I.R.E retirement method, it looks to me like you would use this fund and the other fund and just vary you could vary the allocation of them depending on how much money you needed. But I'm not an expert on F.I.R.E. If that's not right, somebody let me know in the comments. Okay. So fees and expenses. This one is 89 bips. Okay. All right. Principal investment strategy, 6 current income. Okay. In particular, the fund seeks a 4% target annual income level, which is called the 4% target. This target reflects the distribution of income generated from dividends, interest, and other earnings, such as those from real estates or derivatives. So that probably mean options, and excludes capital gains from asset sales. It represents the anticipated recurring income produced by a fund's underlying asset. So this is just a big fund that spits out 4%. It invests in a lot of ETFs, and they try to spit out an average of 4%. Okay, and I bet they do it in a way that preserves the capital. Now, the fund's not out, we don't know, but I can kind of tell by reading the prospectus, they're going to take just as little risk as possible, just try to make 4%, with just zero NAV depletion. I think they're going to use a lot of bonds and I think this is going to be kind of a boring fund, but anyway, let's read and let's see what they say. Okay, strategy overview. As a fund of funds, it invests in assets and shares of other ETFs. The fund primarily invests in affiliated ETFs managed by Tidal. Okay, but it may also invest in unaffiliated ETFs, like I said, managed by ProShares or whoever. Okay, the fund will not invest in ETFs that are structured as a fund of funds or ETFs that invest more than 10% of their assets in other investment companies. They won't buy other fund of funds. Okay. They're going to use a barbell approach to implementing the fund's investment strategy, balancing 2 key components, which is high yielding assets. A portion of the fund's portfolio is allocated to underlying ETFs that invest in higher yielding assets than other financial instruments. The selection of these ETFs follows an income hierarchy prioritization. So here's the hierarchy: yield, income type, leverage, credit quality, duration. All right. Then, in addition to having some high yielding assets to bring in some yield, they're going to have cash equivalents and super low volatility stuff. So I'm thinking like T-bills. The remaining portion of the fund's portfolio is invested in money markets, CDs, T-bills, whatever. Low volatility ETFs that aim to reduce risk and provide stable returns. I'm thinking THTA would be a good one right here, in my opinion. As soon as these come out, maybe we can get Mike on the show. I would love to have Mike on the show. He's a really interesting guy. All right. So they can also just directly hold cash and cash equivalents. But this is the stability part. And what they do, I'm betting, even without reading this, they use just enough of the high yielding part to make the average return of everything together 4%. That's the whole deal. In the FIRE method, you need a 4% repeatable income, evidently. So this gives you that. Let me see if there's anything else in here that you guys would be interested in. See here, it says the advisor continuously monitors the projected yield of the fund's portfolio in relation to the 4% target. If the fund's projected yield falls below 4%, the portfolio manager may adjust the fund's allocation by increasing its exposure to higher yielding assets or replacing certain underlying ETFs with others that offer a better income potential. Conversely, if the fund's projected yield significantly exceeds 4%, the managers may reduce its risk. You know, they're gonna manage it to earn a 4%. It holds between 10 and 25 ETFs. All right, so I think we have a pretty good handle on that. So now let's get back in here to the slideshow. We're going to talk more about endowments, and then we're going to get in the retirement simulator. I'm going to show you how my idea would work. All right. So endowments use fixed income investments, but it could be like covered calls. I always talk about insurance companies and Warren Buffett using them. The institutions will use covered calls to get an income. They'll also use T-bonds, T-bills. They'll also use real estate. They have a stack. An endowment has a stack for growth, but to be well endowed means I have a stack of money. I'm managing it with the intent that it never runs out. So when you're managing money like this, you have to be very aware of interest rates going up, right? Interest rates are the side, well, interest rates and inflation. But there are ETFs like Riser that can deal with that. If it were easy, everyone would do it, but it's a heck of a lot easier today in 2024 than it was in 1994 when I got into the wealth management business. And that's what my book's about. One huge question for endowments are, how are we going to make the income to support the family members that are the current older generation? I spoke yesterday about wanting to die in my own bed someday, not at a state facility. I also want my family to be able to do that. But at the same time, I don't want to eat tuna fish and instant ramen in my older years. So this is where the high yield ETFs come in handy, or other fixed income investments like REITs, municipal bonds, or like that Riser ETF I just mentioned. So my plan to do this is to stay as much as possible in growth and live below my means. Very similar to the FIRE methodology. But let's get in the retirement simulator and see what it has to allow. Okay, so we have a $5 million portfolio, okay? And we've allocated it 4 different ways, A, B, C, and D. We're mainly concentrating on A and B. A is 60 growth, 20 bonds, and then 20% a conservative high yield allocation. So we call it like a mid yield allocation, really. Okay, so let's see what that kind of stuff that has in it. It has SPY-D, which is that's a SPY fund that pays a high dividend. It takes the highest dividend paying stocks out of the S&P 500 and puts them into a fund. And instead of paying 1.3% like the SPY does, this one pays like twice that or something. But anyway, it's a good fixed income fund. SCHD. Okay, very, very stable. You guys know about that. That's the Schwab. That's the Schwab fund. QYLG is one of the best covered call funds out there for upside because it only writes half the amount of underlines. So that's a very stable one. Doesn't make a real high yield, but when you're going for steady, that's what you want. Bondi, that's a very steady one. JPMO, that's very steady. QYLD, you guys know about that from Global X. APLY, it's one of the lower yielding ones, but steady. JEPQ, you guys know what I think about JEPQ. We're going to, in this allocation, we would leave like triple QY out because it's too risky. This is a stable allocation, right? Then we would have XYLD, 1% of that, 1% of XYLG. We have JPMO in here twice. You got to be kidding me. Is that, should we really have JPMO in there twice? Well, I'm sorry about that. All right, well, that IWMY, they just hit their 1-year anniversary, or they hit it this month. So we're going to start being able to compare IWMY. But in any event, okay, so this fund has 99%. We need one more stable fund in there. Let's throw in Goop from Curve. I never talked about Curve. Curve's a great company. Okay, there we have 100%. Super, super stable. $5 million portfolio. Okay, living the maximum lifestyle. Well, the good news is the ending NAV is 6.1 million if you did this a year ago. The bad news is it's only 12,000 a month. It's not a lot of income. There's not a lot of income. If you had two, for instance, if you had two older family members that weren't working anymore, it wouldn't be enough to support both of them. All right, let's say they both need 15 a month to live off of, 20 a month or something. So that's not going to work. This is doing a good job at the growth. It's getting plenty of growth. It's up 25% on the year. So what would we do if somebody came to me in this situation? I would allocate more aggressively, but obviously not stupidly so. And here's what I would do. I would keep 1% in SCHD and QYLG and some of the stable ones, keep 1% in Bondi, keep 1% in JPMO, you know, just basically keep 1% in a lot of them, but throw in triple QI, throw in 5% of triple QI. So knock 1%, knock 5 of the other ones out, choose 5 of the low mid yielding ones, put 5% of triple QI in there. We'll see if that solves the problem. But okay, this adds up to 101. Anyway, we got to knock one out. But this also has SPY-I and F.I.R.E. It has some other good higher yielding funds. We managed this one, allocated this one with a little more emphasis on yield. Okay, so we'll take out DISA. So this one has 100% now. Okay, so mainly it has 5% triple QI, F.I.R.E, SFOL, and a bunch of, F.I.R.E, SPY-I, 1% each, and a bunch of stable ones. It's not that complex of a portfolio. Let's see how it does. Oh, wow. $20,000. Okay, well, this is doing much better. We still had growth. The portfolio is not at 6.1, but it'd be at 6. We still had growth, and we have more income. It just depends on what the needs of the family is at that current time, right? All right, so now let's see if but let's say that wasn't enough income. I mentioned we want 30. Let's say the family has 2 people and you're going to pay them each 15. It's going to take 15 to support 2 older people each. All right, so what do we do in that case? Well, let's do this. We're going to take out some of the lower paying ones. We're going to take out another 5% of the lower paying ones. We're going to take out XOMO, take out TLTW, that's a dog. Take out GLDI, that's a dog. We'll leave F.I.R.E and SPY-I in there. Those are good. So now we have 96%. We need to take 1% of something else out. QYLD, that's a dog. We'll take that out. Okay. Now what we're going to do is we're going to put in 5% of one of the higher yielding ones. Okay. And I always use Tesla for an example because Tesla didn't have the best results last year. But, you know, at the time a year ago, if somebody's wanting to go for yield, Tesla might have seemed like a good one. Now, I would have told him to put it in 5 different funds, but just to make it easy, let's just say we would have had let's go on 5% in Tesla, 5% in triple QI, and then the other 1% scattered around. Let's see how that would have done on income and see if it would have given us too much erosion, which isn't really a thing, but anyway, it is, but it isn't. Okay, so look at this. Here we have $25,000 a month. So they're just going to have to learn to live on 12.5 apiece, the 2 heirs that aren't working anymore. So, but that's pretty good. That's pretty good. We got a 2% debt factor, which equates to erosion when we want to stay under 4%. It's way higher than the 60-20 plus conservative allocation, right? But the conservative allocation was too conservative. We couldn't live on that little amount of money. Over here, yeah, we can live on this amount of money. So this is the way we're going to allocate going forward. 10% in higher yielding funds. I chose triple QI and Tesla, but it could be NVDY and it could be ULTY. ULTY wasn't a year old, so it's not in the retirement simulator. But going forward, it might be ULTY and NVDY or something. Put 5% of those funds in a portfolio of this size, and the rest in all stable stuff, and then still with your growth in your bonds, you're set. $25,000 a month, right? Then you could do the max factor. So this is a guy that and I'm just doing this to see what was possible. So I went through and I made a metric and I maximized for this one. I maximized for, well, one of them I maximized for yield and one of them I maximized for return, but they both yielded and returned about the same for whatever reason. This was the max factor return portfolio. I maximized this one for return, but it still had $42,000, payment. But it took some risk, but it didn't take as much risk as the one I just hand built. This max factor really works. I just want to show you guys a hand built idea, just how to do it in your own. You mix together some lower yielding ones and 2 higher yielding ones until you get the combination of risk and reward that you want. Anyway, this max factor is interesting to me. I've mentioned before it's going to be a subscription service. I haven't figured out the details on that yet, but yes, I will share that with you guys. It's really interesting. But anyway, so for today's lesson is we can FIRE retirement using high yield ETFs. Yeah, we can buy the new ETFs from Tidal. Absolutely. We can do the maximum retirement where we just try to live below our means and use the high yield funds, support the current generation that's not working, but at the same time, still be having growth for the generations that are working that will retire in 20 years, right? So 20, 25 years. My son's 22. So weird to think, I mean, I hope he's retired in 25 years or 20 years if he wants to be retired. But it's weird to think. It's just weird how fast time passes, right? A and B, either one could work. It just depends on what you need. If you can live on $12,000 a month, A is a better plan. If you need $25,000 a month, B is a better plan. If you need $42,000 a month, C is a better plan. C may be a better plan altogether, given the fact that it has less erosion, less dead factor. Like I say, erosion's kind of a misnomer, but I made a metric for you guys that includes what you guys call erosion, and I call it a dead factor. But the fact of it is, we don't want it to be over 4%. That's where alarm bells start going off. Let me know what you think about these new ETFs. I wanted to look at them real quick and get something out. My own thoughts are, why just 4% on the income? I don't get that when you can easily do a lot better. I don't get the 4%, but I think somebody can explain to me in the comments that they manage your money in 2 separate pools. They have a separate fund for growth and a separate fund for income. But I just, as you guys see, that's why I showed you retirement simulator. I believe in one fund does it all. You have your growth, then you have your bonds, and bonds give you some inflation protection, so, some diversification, mild diversification. But then you have your yielding investments, for your return, to pay your daily income to yourself, right? All right, guys. Well, I appreciate y'all for being here. Y'all have a good day.